Welcome back to Investing Talk Podcast. Today we're taking a close look at Richtech Robotics. You shared some information about them, and we're going to unpack what it all means. Our mission here is really to cut through the noise, give you the key insights into this company, its performance, its future potential. We'll explore everything from their, innovative robots to their recent financial news and strategic moves. Is Richtech Robotics a high-risk, high-reward play? Or are the current financial headwinds, just too significant? That's the question we're exploring today.
It is a fascinating situation. I mean, you've got a company in a really dynamic sector, robotics, automation. They're aiming to streamline these labor-intensive operations across several different industries. Their model involves product sales, but also leasing and service contracts, and multiple potential revenue streams there.
Okay, let's dig into that a bit. So RR isn't just like sticking to one type of robot or one industry. You mentioned restaurants, hotels, room service bots, industrial cleaning, food prep. And this is interesting, they're also moving into healthcare. MedBot for medication delivery. That's quite a range.
It really is. And that diversification, well, it could be a major strength. Lets them tap into different markets, maybe offset downturns in one area. The move into healthcare specifically with MedBot, that shows real ambition. Applying tech to areas with critical needs, big growth potential, it does suggest investors might be betting heavily on the long-term view, especially that healthcare angle, seeing it as a big untapped opportunity despite current financial pressures elsewhere.
Okay, now how are they actually doing lately? We don't have the absolute latest stock price trends right here, but we know they're expanding. They've partnered with Ghost Kitchens America. That sounds like a big move for getting robots into more restaurants. So the expansion plans, they sound promising. But how's all this translating financially? Let's look at the second quarter earnings.
That Ghost Kitchens partnership, definitely strategic, taps right into that growing food service segment. And what's also notable is their investment in physical infrastructure. They picked up a 20,000 SKU upfit property in Las Vegas, the goal, a 400% increase in manufacturing and assembly capacity.
Wow, 400%. That is huge. So the idea is to meet demand for these AI-powered service robots and maybe rely less on renting space. Plus, they leased a new office in Newark, California. That's for developing AI and robotics platforms. Sounds like they're putting down some serious roots for future growth.
It definitely signals a commitment. Scaling up operations, enhancing their tech. Now, about that recent financial performance, the second quarter 2025 earnings report, it tells a slightly different story. Revenue was basically flat year over year, $1.17 million. And their net loss, it widened significantly by 306%, hitting $4.54 million. That's a loss per share of 0.04 cents.
Okay, so expansion looks good, future plans sound exciting, but the latest earnings, not so great on the surface. But here's the kicker. Despite that earnings miss, the stock jumped 31% in the past week. And another, 7.49% recently? That seems counterintuitive. A loss widening that much. Is this typical for a company expanding so aggressively? Or is this a worry for what's like a healthy loss here?
Well, that disconnect is what's so interesting. Between the financials and the market reaction, that stock increase plus higher trading volume, it really suggests investors are focused more on the future potential, the expansion plans, less on the immediate earnings figures. It points to strong market optimism despite the losses. Now, it's not unheard of for companies investing heavily like this to see short-term losses widen. Investments take time to pay off. But that 306% increase, that magnitude is something investors will be watching closely, making sure it's a strategic, manageable burn rate.
Right. So looking beyond just one quarter, what about their overall financial health? We don't have every single report here, but what do investors usually look at?
Connecting this to the bigger picture, you'd look at revenue growth over time, net income trends, earnings per share. Debt levels are crucial too. Historical financials give you that context. You can find those on places like Macro Trends or through their official SEC filings. That's the regulatory body.
And we did see notes that EPS has probably been hit by those declining sales projections mentioned earlier, contributing to stock volatility.
That's right. And other key metrics. Think about the debt-to-equity ratio. That tells you about their financial leverage. How much is financed by debt versus equity? A high ratio can mean higher risk. Free cash flow trends show if they're generating cash. Return on equity. How effectively are they using shareholder money to generate profit? Now, we don't have the exact debt-to-equity ratio handy, but investing in Vegas property, leasing in California, it suggests debt or financing needs might be going up, something to monitor in future reports. And the fact that news highlights sustained losses for 3 years, that's definitely something investors are noticing.
Okay, let's pivot slightly. What's working in their favor? And what are the potential, warning signs? Strengths. We mentioned innovation, diversification, not just one or two industries. That healthcare move seems really noteworthy. And customizing robots for clients? That sounds like a plus.
Those are definitely key strengths. Innovation keeps them relevant, diversification mitigates risk, and tailoring solutions that can build stronger customer relationships, make them stickier.
But then the red flags. Potential dependence on specific industries was mentioned. Even with diversification, if a major sector they rely on takes a hit, that could ripple through. And let's face it, the robotics industry is crowded. Lots of competition.
Which brings up that question of competitive positioning. Customization and expanding into new sectors are potential advantages for sure, but they are up against some major players. Maintaining a tech edge, securing market share, that's going to be critical.
So looking ahead, what could really give RR a boost? And what are the potential bumps in the road we should be aware of?
Potential catalysts. Successful new product launches would be big, especially in healthcare or maybe retail. And obviously, positive future earnings reports showing they're moving towards profitability, that would certainly boost confidence.
Makes sense. And the risks.
On the risk side, well, regulatory changes could impact things. Labor laws, rules around robotics deployment, economic downturns are always a risk. Businesses might cut back on automation spending. And fundamentally, there are ongoing financial challenges. The need to actually achieve profitability. That's a persistent risk. You really need to see if they can turn these big expansion plans into actual financial success.
Got it. And finally, what's the general vibe around the company? Stock price is up, but what are people actually saying?
Well, online discussions, places like X, Reddit, they seem to mirror that market optimism we talked about. People seem positive about the strategic moves, the growth potential, but there are definitely concerns too about the financial performance, about when they'll become profitable. It's a mix. Excitement for the future, but caution about the present.
So what does this all mean for you? Richtech Robotics, it's an interesting case. You have innovative ideas, big expansion plans, and clearly they're capturing market enthusiasm. But that's set against recent financial setbacks. The key thing to watch, their ability to translate all that potential into actual, tangible financial results. Keep an eye on those earnings reports, see how the new facilities impact operations. It really raises the question, can their strategic investments overcome these current financial headwinds and deliver sustained growth? Definitely something worth following as you think about the broader robotics and AI sectors. And hey, if you found this useful and want to explore other companies with us, remember to subscribe, like, and comment. It helps us know what you want to hear about.